Welcome back to the Live Off Rents podcast by Spark Rental. As always, I'm your host, Brian Davis, and I am on a journey to reach financial independence, and I'm not on that journey alone. Every month in our co-investing club, we get together with an entire club's worth of investors, passive real estate investors. We vet different passive investments together. We go in on them together. I invest my personal money in every single investment as my strategy for investing in real estate. And it's a lot of fun. And as part of that investment club, we bring in a lot of outside experts to come and speak on different topics. So today we've brought in Erik Oliver to come speak here on the podcast about how depreciation recapture works and how you can avoid it. So Erik, take it away. Tell us, what do investors need to know? What do real estate investors need to know about depreciation recapture, and how do they dodge that bullet when it comes time to sell their properties?
Yeah, that's a great question. And that's a question we get asked quite often by both tax preparers and real estate investors, especially when they're looking at things like cost segregation is, hey, if I accelerate all this depreciation on my property up front, isn't this just a timing issue? I'm going to have to pay all this back when I sell the asset in a few years, correct? And the answer is not really, and I'll kind of explain why that is. So the whole idea behind cost segregation and depreciation recapture is you're taking your deduction against your ordinary income today. So let's say I'm in a 35% tax bracket. I'm going to get my deduction today at 35%. If and when I sell the asset down the road, I'm paying it back at a recapture rate of 25%, or in a better case, a capital gains rate of 20% and saving that 10 or 15% spread. And I'm not actually paying it all back. I'm only paying it some of it back. And I'll kind of walk you through how that works. So imagine let's say you buy a residential rental. I'm just going to use whole numbers for $1 million, and you sell it 5 years later for $2 million. When you go settle up with the IRS, you're telling them that everything has doubled in value over those 5 years. I bought this residential rental and all the stuff inside of it for $1 million. I'm selling this residential rental and all the stuff inside of it for $2 million 5 years later. So it must have doubled in value. Well, your walls have doubled in value and your land has probably doubled in value, but certainly your dirty, nasty, stained carpet that's 5 years old has not doubled in value. Carpet doesn't go up in value. Carpet goes down in value. In fact, the IRS says carpet is a 5-year asset and has zero book value after owning it for 5 years. So in that example where I bought the residential rental for $1 million and I sold it 5 years later for $2 million, what is the book value of my carpet after owning it for 5 years? Well, it's zero, has zero book value. So why am I telling the IRS that my carpet is now worth double and paying tax on that? Well, the reason that that happens, it's unintentional, but the reason that it happens is because you don't have all of your items segregated. You just have on your depreciation schedule a line item that says building. And so when you sell it, you say, hey, my building was worth $1 million. My building is now worth $2 million, and I pay tax on all that $1 million of gain. And what should happen is you should say, my land went up in value, my walls went up in value, but my 5-year carpet, my 5-year assets, or my carpet, for example, is now worth zero, and you pay no recapture tax on that carpet. It's fully depreciated. So again, in summary, you take your deduction against your ordinary income rate of today. So I'm in a 35% tax bracket. I take it against income that's taxed at 35. I pay back a portion of it. That portion is dependent upon how long I've owned the asset. The longer I own it, the less I pay back a portion of it at a lower rate at a future date and save the spread. And so that's why sometimes we'll work with commercial real estate brokers. We'll work with residential real estate brokers who are getting ready to sell a property. Maybe I bought a property 10 years ago for $300,000. I'm getting ready to sell it for $600,000. And right before I sell it, sometimes it makes sense to do a cost seg study to say, hey, when I sell this, let's put a value to my carpet. Let's put a value to my driveway. Let's put a value to my walls so that we can allocate the sales price to the right buckets so that we're not telling the IRS that, hey, our carpet is worth double what we bought it for. And so those are just a few tactics that you can utilize when selling a property and having to deal with that recapture tax, is being able to allocate the sales price so that you can create a permanent tax savings.
So that's fascinating. Yeah, I never knew that you can that you don't owe back, everything that you took in depreciation, that you don't necessarily owe all of that back in depreciation recapture. That's an interesting model. And does that require a second cost segregation study done at the time of sale?
We have done what we call price allocation studies. Oftentimes, CPAs, especially on smaller properties, they can use tables to say, okay, we've got these assets in this 5-year bucket. We've owned these assets for 3 years, meaning they have 2 years worth of value left. What is that value? And there's different tables out there that different government agencies will provide, different entities that will say, okay, if you have 5-year assets, they've been utilized for 3 years, they've got 2 years left of value, let's use 27% of what their original cost was. There's certain percentages that can be used so that your tax preparer can put the correct value to those assets upon sale.
Interesting. I love it. Well, Erik, in 30 seconds or less, how do you help people and how can people connect with you if they want to take you up on that help?
Yeah, no, that's a great question. So we work with investors and tax preparers across the country, utilizing some of these different strategies on real estate to reduce tax liability. So we're a little bit of a unique accounting firm where we don't do tax returns. So don't call me and ask me about earned business income or child tax credits, because I don't know anything about that stuff. But if you've got real estate questions, depreciation questions, we can usually get the answer for you. So please use us as a resource. You can find us at www.costsegadauthority.com. On that site, we'll offer a free benefit analysis. So if you or an investor has a property that you would like us to look at, we do a free analysis before ever engaging our clients to make sure that there's going to be substantial tax savings. And you can find that information on that website, www.costsegadauthority.com.
Awesome. Well, Erik, thank you so much for joining us today. And guys, if you enjoy these quick, focused conversations that we have on the show, please rate and review the podcast, and we will catch you on the flip side. Want the cash flow, appreciation, and tax benefits of real estate without becoming a landlord? You've heard of REITs and real estate crowdfunding, but you probably don't know much about 5 other ways to invest passively in real estate. So we put together a free video course for you to show you how to consistently earn 15% plus returns from 5 lesser known hands-off ways to invest in real estate. And even more importantly, we'll keep risk front and center in that whole discussion, because really, what's the point of investing for high returns if you also take on high risk, right? So visit sparkrental.com/free to take our free course. Each video is snackable at 10 to 15 minutes long, and the entire course takes less time than watching a movie. Looking forward to chatting with you from within the course.